Good morning or good afternoon if you're in Europe and beyond. I'm Rob Cox, the global editor of Reuters Breaking Views. Welcome to this virtual Reuters Newsmaker with Bruce Flatt, the chief executive of Brookfield Asset Management, one of the world's leading alternative asset managers. I'll also be joined in today's discussion by Reuters Breaking Views deputy editor Richard Beals. Richard will be going through questions that you out there, the audience, send in via the Q&A widget that's registered participants should be able to see on their screens. But please do not hesitate to lob in your questions, though I can't promise we'll get to all of them. Richard will fillet some of the best for Bruce at the end of our chat. This is the third virtual session we have done during the pandemic, and it coincides with a book my colleagues at Breaking Views recently published looking at what will change when the disease and the great lockdown have passed. Please go to breakingviews.com or check on your icon screen to download a PDF of Once in a Lifetime. I was particularly excited that Bruce agreed to sit down with us, given the breadth and depth of investments that Brookfield has in different asset classes and geographies around the world. The Toronto-based group's holdings range from Canary Wharf office complex in London, where we have our offices, to prime Manhattan real estate. They include Brazilian toll roads, even an entire city outside of Mumbai. And just last year, Brookfield acquired Oaktree, an investment firm dedicated to buying distressed assets. Not a bad call, if you think about it, given the market meltdown a few months ago. Bruce joins us now from London. Good afternoon, Mr. Flatt. How are you?
Thanks, Rob. Good to be here.
So I guess you're in Canary Wharf.
I am, across from your office.
Right. Well, I'm in the wilds of Connecticut. I think Richard is in New York, but let's get into it. So I just thought to start, it would be great to get a sense of where you think we are in terms of the economic crisis or market crisis related to the pandemic. Are you a believer that we're on the cusp of some great recovery here, or do you see a false dawn? Are you worried about a spike again in cases? Where do you see sort of the world economy at the moment, and what's your perspective?
Look, Rob, here's what I would say. The world is, everybody looks for one thing or the other often. It's much more nuanced than that. And we're in an environment where, and I guess the most positive thing I would say, and we try to tell all our people and all our clients, is that this too shall pass. We always go through these. I've been through a number of them myself, and they always do pass. And the one thing that I always think about is that when you're in them, it always seems like it's the worst one. And It does for the current moment, but all the other ones were bad too. And 2008 was bad for all, especially financial groups. And I'll put real estate, infrastructure, private equity into that. The 9/11 attacks were for New York-based organizations like ours were very traumatic. So it always seems bad at the moment. I would say this one will pass. Coming to the current situation. Look, we see green shoots around the world and things opening up everywhere, but we must get things open up in the rest of the places, or we're going to retrace in the economic situation. And it's that simple. We have to get things open, but we're seeing it happening in many different places, and that's a positive.
Do you think the market? You look at the stock market. The S&P has basically gotten back to where it was at the start of the year. Your stock price is pretty much, flat. I mean, you like everything, it dipped for a while. Is the market getting it right, or do you think it's over anticipating a return to something like normal?
Look, in the real economy, things are still tough. There's major industries that have zero revenues today. And in many, many businesses, the markets are still very tough. So people are either looking to 2021 and forgotten about what the numbers are, or they expect that the Fed is going to be pumping liquidity into the markets for a long period of time. We'll find out in due course which one is right. But there's no doubt our view was, and we can talk about it if you wish, but our view was stock markets for 2 years were fairly valued. I'll use that term.
Yeah.
And today, while there is a pandemic going on, they're back to the same points of being fairly valued at the end of last year, early this year. So that probably answers your question.
Well, that sounds like we've talked about this before. that, you were, and we can go back to your Oaktree investment a bit, which is you expected that we were at, sort of pretty heady valuations. We're back to those valuations, but with an outlook that's less certain, if you will, or it's at least with more obvious risks. So you're basically bearish on the market?
Here's what I would say. In March, we were buying our securities, and we were buying securities in many investments in the stock market in our various funds, because we felt that the stock markets on March 15th, March 30th, April 15th, during that month, and a little longer maybe, were undervaluing true tangible value. Today, they're not undervaluing tangible value, and some of those securities that we purchased are being sold. So that I would say, whether they're fairly valued, we'll only know in the future. They're down because more money is being pumped into the system, and it was the right thing that the Fed did to avoid an economic depression, possibly. And secondly, because interest rates are now zero around the world. They were always zero in Japan, always. 30 years they've been zero in Japan. But they're zero everywhere in the world. And what that means for asset classes and values of assets and value of businesses is unclear. What it probably does mean is that valuation multiples, PE multiples, valuations for real assets, valuation for real estate, are going to be higher in the future once you normalize the environment, if you keep rates low. And we think rates will stay low for a while.
Now, you and I spoke, I think I was visiting you in February before everything happened, before the crisis really hit, I should say. And I recall you were wary of a downturn. And one of the ways that you were preparing for that was by buying Oaktree, which is a specialist in companies in distress, basically buys the debt and gets to own the companies through bankruptcies and defaults. Do you think that you mentioned the Fed, the amount of money that's been pumped in, not just by the Fed, the Bank of England, the European Central Bank, and other central banks, has sort of stabbed off this necessary or sort of inevitable part of capitalism where we have defaults, where we have companies that need to restructure their debts. Are you concerned that sort of natural course has been interrupted in some way?
Here's what I'd say. If you step back, what we have been doing over the last number of years, we were worried that the markets were high. No one ever knows whether they'll end or whether they'll stop, but what you can do is prepare. And we put more cash in our balance sheets. We extended out the maturity of our financings. We liquefied things if we could liquefy, and we were ready, which meant you earned less because you were less aggressive. And the last thing we did was we came upon the idea to partner with the team at Oaktree. And this was our last piece of the story, was to have a distressed debt business to be able to capitalize on a situation like today. There's no doubt in March and April, that franchise was buying a lot of securities. Today, they're buying less. But what that doesn't mean is that the equitizations and the amounts of leverage that are sitting in companies aren't going to have to be refinanced. And we believe there will be significant opportunity coming 3 months from now, 6 months from now, 9 months from now. And possibly we're going to get the best thing for everybody, because we avoided the true economic collapse, which might have occurred if they didn't do what they were doing. And you'll have a slow equitization of all of these businesses over the next year and a half. And as you do that, we'll have a normalization as opposed to a collapse. And that may be the best thing that can happen. And therefore, the short answer is, look, the opportunities are coming, and we think there'll be lots of opportunity for the Oaktree franchise.
Thinking about the global reach of your group, I'm wondering if you're seeing major differences in the way the pandemic or just the economic impact is playing out, and whether there are certain countries or regions where you're seeing policy responses that have ensured better outcomes, say, from an economic perspective.
Look, I think the way I'd put it is not often do you have a situation that occurs where it affects every single country in the world. This affected virtually every single country. Normally you have a recession and it hits Asia, or it hits North America, or it hits the developed markets, or it hits South America. What happened here is it hit everywhere. But it hit at different periods of time. And what I can tell you is our Asian businesses, both the operating businesses we have, therefore the real people that are on the ground running the businesses, and our investment businesses are up and running 100% and everyone's back in the office and working. And and that's occurring across the world. Australia opened 2 weeks ago. Dubai's now open. So we moved across the world, and we're coming to London's now opening soon. The US is opening in various markets. And so I think it's just time. And all of the markets are going to experience, and it's nuances. Some are doing it a little slower and some are doing it a little faster. What's right, I don't know. Health experts have to decide that. But our only encouragement is we have to get back and we have to get the economy moving.
Let's discuss some of the specific areas where Brookfield is a big investor. We can talk about the office. I mean, you mentioned it right there that, you have folks coming back. You're there at Canary Wharf. Some of us, I'm here in the wilds of Connecticut at home. Richard is in New York. We haven't yet returned to our office. But what will happen to, let's think bigger picture? What's going to happen to the office? Because there's a lot of talk about, now that people can work from home, they don't need to go to the office. There'll be less need for office space. What's your take on that, being, of course, a very large investor in commercial property?
Look, here's what I would say. And this is really simple, and it's by observation over a long period of time. Culture of a company is about its people, the spontaneity that happens with groups of people, the creativity that comes out of those people being together, the interjection of ideas, and you need to have physical space to do that. So our view is that it is ludicrous to think that companies will not return to offices, and they will return to offices. And anybody that says that they're going to not be in offices, I think is naive to how a culture is built in a company, because you can possibly, you can maintain by video conference a business for a while. You cannot build a culture, and over the longer term, you will never maintain a culture of a business by video conference. In addition, I can tell you that when you ask most people, they don't like actually sitting at home and doing all the things that they have to do at home and not having an office. So I guess there's just human.
Yeah, we've spent a bit of time, everyone has, analyzing, productivity, interactions, all that. I guess a couple of things that do come through is, we were doing a survey with our employees. The amount of time that people save not commuting seems to be a benefit, of course. I don't think anyone's saying they don't ever want to go into an office, which means there's always got to be a desk there. Nobody wants to do things like, what do you call them? Like shared, hot desking, because they're like, what icky things has someone left on that desk before them? So I'm just wondering whether the office itself looks different and whether that has some sort of impact on commercial property.
Yeah, no doubt. I think, firstly, you're right. There are, again, there's never cut and dry things in anything. And what you're going to see, though, and we're doing it today, we're installing, where there's open plan, we're installing glass panels between desks.
Right.
It doesn't disrupt the open plan, but it makes people feel more comfortable. We're disinfecting the offices more often. We're routing the offices where people can only walk one way. We're temperature testing at the lobbies of many of our buildings. We're 4 people to an elevator, possibly 3, no more than that. So there's many, many things. People don't touch elevators anymore. Doors open automatically. So all of those things are going to happen. And I think what's possibly going to happen, yes, some people may work from home if they can, and they can get their job done more than they did before. But the spontaneity and culture of a business needs an office.
Yeah. You mentioned the elevator. That's it. We wrote a piece as part of our sort of predictive, what will change. We had a piece about big elevator, the 4 big European US guys fighting it out. I'm sure there's Asian players as well. It was an extraordinarily popular story. I mean, it was the top story for a week on our website. I'm just curious, what happens to the elevator guys? You just mentioned 2 or 3 people. I just know even in the before times, waiting 5, 7, 8 minutes thinking, my God, but how is this all going to work? Who are the winners in that?
Yeah, first, you should get a new office building in New York. Maybe you should come and see us, and we could take care of you because you don't have to wait 5 minutes at our building.
Well, if our CEO is listening, I'll assume he heard that.
But look, what I would say is I think many of these things, again, are going to pass. We're going to find a vaccine. We're going to get comfortable with this. It's going to go away. In due course, we're going to have differences for the time being. But then some things are going to pass and it will go back to normal. Now, if you go back to 9/11, people said nobody will go to office buildings again other than on the first 5 floors. That went away, of course. But what didn't go away is that we have bomb dogs at many buildings, and we have metal detectors going into buildings, and we have security desks to be able to check identification people going into buildings. That came from 9/11.
Yeah.
So there are lasting things that are going to occur. And you know what? They're good. They're going to be good. They're going to prevent the next pandemic if we ever have a second occurrence. Healthcare is going to be better taken care of. They're in a better situation to take care of it. They're more prepared. And we as office building owners and every other business owner is more prepared. We know what it is. Unfortunately, the next time one of these occurs, it won't be the same. But if it was the same, we'd be prepared.
Right.
But those small little things are just nuances, I'd say.
Yeah, certainly. What happens to this sort of shared office, the WeWork model in the post-pandemic era?
Look, I think to a small extent, offices that are for smaller businesses or for short-term space for people to get up and running makes sense. And we lease space to many of these groups, and I think there will be some in the future. To the extent that there are environments where everything was going to change to short-term space, that's not going to happen. And you mentioned it earlier, the hot desking. I think hot desking probably is not going to be in existence for a long time, maybe forever. And we were never a big fan of that within a company, partly because we like people to have as many desks as possible. But what is going to change is just the amount of personal space within a building. And we've had probably more tenants ask us for more space since this all occurred than less. Now they have leases, so they can't really get out of space, but they could ask us to sublet or things, and we really haven't had that. We have more people asking us about other space that they could build out to accommodate more distancing for their people.
All right, let's turn to retail. You're also, unlike some other alternative asset managers like Blackstone and others, you're quite bullish on malls. Given the carnage, we've seen a carnage in retail that's been brought along by digitalization and accelerated by the pandemic. What gives you confidence in the mall business or the retail business generally?
Yeah, so look, we have a lot of real estate. We have $200 billion of real estate. 40% of it is invested in retail, so a good portion of it. But it's in our permanent capital vehicle, largely not in our funds. And what that allows us to do is have a very long-term view of the strategies that we operate. And our view has been great retail will be better in the future. And again, things are going to adapt. And one thing that's happening today is we are delivering out of the malls today as they've been opening up on the curbside. And I think that will be something that is staying. And remember, there is only one retailer in America that delivers to your door. All other retailers do it from stores. And what we have is a physical location. Our malls are a physical location of their inventory. And that inventory will get delivered out of those malls. And increasingly, the online plus store retail is intermixing. So our view has been that we're in the middle of that in a value play to integrate those together.
This doesn't mean malls become fulfillment centers, does it, or distribution?
No, they're not going to become warehouses, but they're showrooms places to pick up goods. Possibly you went there and bought something, but also they will fulfill out of those centers, because even just our malls touch 60% of the American population within an hour's drive. So you can come and pick up within an hour any good out of the stores. And remember, all the inventory is sitting there. And that's what's going to happen across the world. In addition to that, and the big play for us over the next 25 years is to redevelop these centers into other things: office buildings, hotels, residential apartments, condominiums. Because remember, these are, if you think of it, they're 100-acre pieces of land in every major city in America.
Right.
And so good retail, we think, will be very good in the long term. There's no doubt, and I will just make the differentiation. If you have a poor mall in an area that isn't so high quality, it probably will get plowed down over the next 10 years. And the good news is this situation we're in today is actually advancing that process. So that's very good for the retailers, and it's good for us.
One thing, and you probably saw this morning, Simon Property terminated its merger agreement with Taubman Centers. This was viewed as a huge, the biggest mall merger. What does that mean? How should we read that?
I have no views on the Simon Taubman merger drop of that, so I really don't have any comments. I don't know anything of the current situation.
Sure, it crossed the tape this morning, so I figured I'd throw it at you. Now, you also have launched this thing called the Retail Revitalization Program. It's a $5 billion fund that focuses on retail businesses with $250 million or greater in normalized revenue that have been around for a couple of years. How does this investment fund work, and what kind of returns can be expected from this? Or should we even think of the returns from that as something separate from just the general investments in real estate that you all make?
Yes, very separate. And our view is, and this is kind of like with everything we do, if you're in a business, look adjunct to it, use the information you have, and try to make money out of doing it. And so our view is that there's there's very little capital going into retail today. What that means is that there are value opportunities. We have information about many of these retailers. We have relationships with them. We can help them. And to the extent we can make investments for value and for significant upside, we'll invest into opportunities. And,
so it's not sort of like, oh, we'll lose some money here to keep money going here. It's generally you have specific investment criteria and return hurdles there that are separate and distinct from those.
Yeah, it's just, look, it is. We have a great informational advantage over most others to be able to take advantage of, to invest into opportunities. And we have the relationship with these. We've been doing a few of them before all of this happened. They were all very successful. And we think we can do more out of this, but we're going to be selective. We'll pick the ones that make sense. And to the fact, I'd say there's a tangential benefit. If we can help some of those retailers and they get back on their feet quicker, then it's good for other businesses too. But that's not the main goal. Is to make money for our clients.
Let me turn to the energy complex. Do you see cheap oil, which we've seen as a result of the pandemic and, of course, the Russia, Saudi, OPEC kerfuffle? Do you think cheap oil will throw this drive to renewables to the curbside, or like other megatrends, is it accelerated in some way? Where do you stand on that?
Look, I think people are going to be more focused on the ESG complex once this all settles down. And what that means is that they're going to push towards renewables, maybe at the same pace as before and possibly at a greater pace. We've had a renewables business for 20 years before it was even called renewables. And as I think the largest owner of renewables outside any government in the world, we've been pushing originally hydro, then into wind, and now significantly into solar around the world. And we think there's a big acceleration going to happen with renewables, because really the cost curves have been coming down with both technology, but more importantly, manufacturing capacity. And that's allowed, in particular, solar in many markets to become the the price that sets the price in the market. And therefore, I think you're going to see a continued acceleration of renewables.
So despite $30, oil.
Remember, oil isn't burned for electricity. It's burned for cars. It's burned for jets or airlines and trucks. It's not really used in this. Now, natural gas is, and natural gas often sets the price in markets. And natural gas has been very low. So I don't think there's any change in renewables based on what happens in oil. But certainly with natural gas, it has, and that's already happened over the past 10 years.
Right. So this long-term trend continues. I think that's interesting. What you mentioned ESG. I mean, we just talked about the E, if you will, but the bigger picture, when you think of the move that everyone was talking about, and the Business Roundtable in the U.S. was endorsing towards a stakeholder capitalism, one where not just shareholders' interests are front and center, but also employees and others. Do you think this event or this crisis has accelerated that trend towards some sort of different form of capitalism? And how are you seeing it at Brookfield?
Look, I'd say our businesses, remember what we operate largely are essential services around the world, which are backbone of the economy. And therefore, we're embedded in the communities. Many of these are regulated assets. They take care of people every day. And the fact is, you have to operate with the highest of standards and take care of everyone in the environment, including the community that you operate in. So we have programs and things in 30 countries in the world and many different parts of the countries. And if you're going to run that many businesses, you have to take care of all those stakeholders. So we've always tried to integrate that into our businesses. And but I think increasingly going forward, we can always do more, and we will do more. And I think the situation we're in is going to accelerate many things, including that.
I mean, one of the things that you guys did was a slight shift to your governance structure. Maybe you can explain why what the purpose of that was. That I guess that would qualify under the G part of ESG. A lot of private equity firms or alternative investment managers have done various things, whether they move from units to common stock or change voting rights. What was it? Maybe you could explain what Brookfield did and how that investors should interpret that.
Yeah, so we've had a partnership, just for everyone's benefit. We've had a partnership that's controlled Brookfield for 50 years. 25 years ago, we put it into a different structure, and it's existed for 25 years. Over the last while, we streamlined the structure and made it simpler and more clear to ensure that we could pass through generations the culture that we have in this organization. And that partnership has allowed us to invest for very long periods of time, to make value investment bets when they were contrarian in nature. And as a result of that, all of our shareholders and our clients have done very well for a long period of time. And what this streamlining did was now ensure that it's very clear what's there, but it can be passed through generations. And we hope the culture, it's been 50 years, we hope it can be another 50 years, in particular with this structure in place.
And the change was just a shift in the number of people who vote? Is that how?
Basically, the 8 people that had the majority of the votes before in the partnership put the voting rights into their hands individually, including myself. But over time, that transfers to other partners if they're no longer alive. Right. And so it's the structure is now set up to live generations.
Understood. Couple of quick questions, just going back to your sort of portfolio. How will broadly the pandemic change the private equity business? I mean, are you expecting taxes to go up on things like leverage or carried interest? I mean, how are you viewing the return or the private equity business in light of all that?
I think you can take situations like this and you can look at them in two different ways. You can look at them in a negative way or a positive way. And we tend to try to look at things in a positive way. I think there will be tremendous opportunity that comes out of this. Of course, you had to be prepared for it before, because those that weren't may not be in existence afterwards. But if you were, there will be lots of opportunity that comes out of it. It allows you to reset things that you do and how you do business. We're sitting back and thinking, what are the things that we can do better? And what are the things that we can we do different in the future? So I think there will be changes. There's no doubt with the amount of government financing that's been pumped into the system on a global basis that probably the only way to pay it back is increased taxes on a global basis. Part of it is hopefully GDP growth, which takes care of a big portion of it, but some of it is going to have to be probably taxes in due time. Although the one thing that people forget about is that interest rates used to be 6% for governments, then there were 4% for governments, then there were 2% for governments, and now they're 0. And that takes care of a big portion of the weight of the extra issuance of debt on many countries, not all, but many. And so I think it's like everything, it's going to be some of all.
Yeah. One last question, then I think maybe we can go into Richard and look at what our participants are asking. But how did you also invest in infrastructure with long-term horizon? I mean, how did those investments hold up during the crisis, or what has shifted in your view about those investments as a result of what we've seen with the pandemic?
Yeah, so our infrastructure business is very significant. It's very global, and it's in all different types. But the 80% are regulated or contracted type businesses, and they stood up extremely well during this environment. And just to give you an indication of what these are, is every single investment we have in every country that we own it in was deemed to be a critical service. And our people, therefore, were operating those assets every single day through this pandemic. So just gives you the indication of the importance of those assets in the portfolio. And as a result, the cash flows withstood very well in all of virtually every case. The only ones on the edge are the GDP sensitive assets like a toll road or a railway, where they have volume. They have volume risk, and we did have some lower volumes, but
things like telecommunications or that kind of thing, I suppose.
Well, our telecom tower business was up because data usage was much more significant than we expected during this environment.
Yeah. So, Richard, do you have? Bruce and I have been chatting for half an hour. Why don't we throw it, as it were, to the audience out there and see what questions they might have?
Well, thanks for that. That was fascinating. We have some great questions here too. I'm just going to combine a couple together. First, Bruce. So one question is, how has your definition of risk changed post-COVID? Do you see a prolonged reverse globalization? That's a specific question. But I think related, which asset class or classes, I guess, do you think are best positioned to capture gains in the recovering market?
Yeah, so look, here's what I would say. We don't, other than a few businesses we have in private equity, we don't trade over borders. What we do is make investments in critical real assets within a country, and then we operate those assets within those countries. So we don't necessarily get impacted by global trade like many significant trading businesses that have operations all around the world and they ship goods. So I don't have a significantly good opinion on global trade. What I would say is that where we have today situations where we have global trade, and I'll give you an example, in the construction business that we have in many countries in the world, we're having supply chain issues getting goods. And that's disrupted today, largely because of COVID. Look, we're a believer in capitalism, and I think you will see some further insourcing to countries of some products, but I think you will continue to see specialization around the world in manufacturing capacity, and I don't think globalization is going to totally go backward, but it doesn't necessarily affect us.
How about your pick of asset classes?
Yeah, so sorry, I forgot your second question. On asset classes, look, I think the one asset class that proved to be an incredible asset through this situation, and that will going forward both be a great asset class, has shown to be durable and does produce very strong cash flows as infrastructure. And I'd include renewables in that. So infrastructure renewables, I think has been increasingly getting filled into portfolios of institutions. And I think there will be a major shift of funding to that. And the good news is, going back to Rob's question of earlier, where do we get the money to pay for all of this? More and more infrastructure will continue to be taken off of balance sheets of governments around the world and funded by private enterprise. So we're going to be building more railways, more toll roads, more water systems, more pipelines. And all of that's going to be capital lifted off governments' balance sheets so that they don't have it in their budgets. And that means that there's money there for the asset class because the institutional investors were into it and now they've seen how it's performed. But the supply is coming as well. And that's been coming for 20 years, but it's been increasingly coming. And I think it's going to go exponential as we coming out of this for those two reasons.
Okay, that's interesting. Now, to a bit of a different topic, a couple of questions about things we might see from you, from Brookfield going forward. One relates to stakes in public companies. British Land is the example. Will we see more of that kind of activity from you? Is that a particular opportunity from this situation, I guess, is the question. And this is actually on behalf of one of my Reuters colleagues, is a more specific question. We've obviously reported on Brookfield potentially being interested in teaming up with Sycamore on JCPenney. I mean, that's a specific example. Don't know if you can talk about that, but that kind of idea with some of these struggling retailers.
Yeah, so on the public stakes, we took a view that the cheapest way, in fact, the only way in March, because you couldn't do anything else, you couldn't do a private transaction, was to buy liquid stakes in securities. And we felt I think it ended up being 12 companies that we invested a pretty sizable amount of money into each that we knew very well and we felt comfortable with putting capital to work. And some of those will just get sold. Some of them in the future may turn into some other opportunity. Who knows what the future brings, their investments for the time being. And I'd say largely at the stock market increases that we've seen across the board, we're not buying very many more of them right now. In fact, as I said earlier, we've been sold a few, but it's not to say that we wouldn't start it again. We try to be adaptable with our investment strategy, or flexible to be able to execute what the best way to get investments. With respect to your other question on retailers in the United States, our fund was set up to partner, work with, help retailers, and to the extent there's an opportunity, I'm sure our team are looking at it.
Okay, suitably non-committal on that specific case. Can I ask a specific one about bailouts? I guess as a general question, what do you think about bailouts and the impact on that? But this is on you and the Canadian small business real estate bailout. I forget, it's CECRA, SECRA, it's probably called. giving tenants a break on the rent giving landlords some subsidy on the rent if they discount it for tenants. Is that a sort of good concept for you? If you don't know anything about that particular scheme, maybe we should pass on that. But
yeah, look, I would just say the following. The biggest issue that's happening globally, and this is in every single country in the world. We have real estate in 22 of the 30 countries we do business in. In every single country, small businesses are the one that are suffering the most, and they're the least able to survive zero cash flows when they're shut down. And to the extent that governments can assist small business stay in business, that's very helpful for, of course, people that own real estate, but more importantly, for the economy and for employment, because when small business goes down, people lose jobs, and it takes a long time to get those businesses back up and running. So our view is that we're for encouraging everywhere the government to ensure that they put small business back into business. And to the extent we can be helpful doing that, we're trying to be helpful.
We had one, it actually came in right before we started. I mentioned it then, I'll repeat it now. You talked about transitions to renewables. You also invest in gas pipelines, for example. How do you contextualize them together? Why are you still investing in fossil fuel pipelines if there's a transition underway, long-term transition underway to renewables, I guess is the question.
Yeah, so look, our view is that renewables in the longer term will be a big portion of the stack of electricity, but it's going to take a very long period of time. And in the fullness of time, it may be 20%, 30%, 40% of capacity. Something needs to fill that in, and gas will continue to be an important either bridge fuel or permanent fuel that's out there. And it has some emissions, but it's not as bad as many that are there. And therefore, natural gas is still an important commodity. And some people don't take that view of what it is and just say we shouldn't have anything, but we have to have something to run the world. And so our view still is that natural gas pipelines are an important critical infrastructure in the economy for the next 20, 30, 40 years. And the investments we're making will pay off very well during that period of time.
Okay, now there's a bunch of questions relating sort of loosely around the topic of very low interest rates and very high leverage, potentially within perhaps your own property portfolios, but I guess everybody's investments in general. The question of is leverage at these very low rates a risky thing for the future? Assets therefore mispriced and so on. So I guess that's a broad topic, but is leverage a big concern, whether it's in the investments you make, in the markets you're in valuations?
Yeah, I don't, look, other than hotels that have been shut and some retail that won't get back up and running, most office buildings, people collected their rents and therefore they have mortgages on them. They'll be able to pay their rent. This is not a crisis. This isn't a commercial real estate crisis that we're in. There was a few months where people may have had some issues, but it's not that situation. So I would say other than places where people had too much leverage and more importantly, that it wasn't structured properly. Our leverage within our real estate company is mortgage by building, by building, by building, by building. None of them cross-collateralize and none of them have any other guarantees on them. So while we are a very responsible borrower with all of our banks and institutions, everyone stands on its own and is largely investment grade. So we don't have we don't believe we have any real issues with financing within our portfolio. But I don't even think, broadly speaking, there's that significant issue out there. And you haven't seen that many quote unquote blow-ups in the last 3 months, and it's because of that.
Can I just ask one question that you and I talked about, Richard, before, which is one thing when you look at the portfolio, Bruce, of Brookfield, and compare it to, say, some of the other more, I don't know, a Blackstone or some of the other private equity firms, you don't have like a tech or growth, growth equity, I don't know what they call it, that kind of area. Tech is sort of what is sort of the handy word for it. Is that something you consciously are avoiding? Is it something you actually think you have through some other vehicle, or is it something you want to get into?
So I 2 points. First one is we've always, probably more than any of the equivalent investors, we've been value type investors. So we try to have serious amounts of capital, more than most. We try to have operating expertise within our businesses, and then we try to move money around the world where we can find value for less than replacement cost. And our general view is that if you can buy less than replacement cost, it is valuable to the situation. So I would say that's been our bent. What that's led to is that we've never really been a technology investor. We started 3 years ago a technology group in Palo Alto. We've been investing into, again, going back to our thesis of business, we're investing in real asset technology for real asset strategies ancillary to the businesses that we operate. So we have a company that does locks for multifamily buildings, and we're doing software for leasing for tenants and goods from ports in Los Angeles with an app and different things. And so we're starting into it, but it's a small component of our business.
Back to you, Richard.
Yeah, that's interesting. And just switching to the sort of regional country question, do you see any difference, or which regions do you think are better positioned? US, Europe, China, Asia, Africa? I guess we're talking about for the coming years in the post-virus world.